You got a raise 4 months ago, and you still cannot point to where it went. The paycheck is bigger, you can see it on the stub, but the checking account at the end of the month looks almost exactly the same as it did before the bump. You are not blowing money on anything obvious. There is no shopping spree, no luxury subscription you forgot about. The bills just seem to absorb it. Rent, insurance, groceries, the card payment, the car. And by the time everything clears, there's almost nothing left to show for the extra income. That is not a spending problem. It is a structure problem. And it has a pattern. When income rises, but every dollar is already assigned to a recurring obligation or a debt payment, the raise lands on a board that is already full. It gets absorbed into existing commitments before it ever has a chance to become savings, a buffer, or real forward progress. About 6 in 10 adults said higher prices made their financial situation worse over the past year, which means a lot of households are not falling behind because they earn too little. They are falling behind because the cost of staying in place keeps rising faster than the paycheck does. I am Sam from Simply Money, and I have spent way too much time studying why people with healthy-looking paychecks still cannot get ahead, and it almost always comes back to the same invisible structure. If you are someone who earns a decent income but still feels like every month ends at zero no matter what changes, subscribe, because diagnosing that exact trap is what this channel is built for. Today I'm going to walk you through a 4-part framework for seeing the gap between your paycheck and your progress, so you can find the specific place where the money disappears before it becomes anything durable. Let me start with the part of the problem that hides in plain sight. The part that hides in plain sight is what happened to prices while the paycheck was growing. About 6 in 10 adults said that price increases over the past year made their financial situation worse. That is not a small, frustrated minority. That is a majority of households saying the same thing. The cost of staying in place went up, and it went up fast enough that a bigger paycheck did not actually feel bigger. So your raise landed, but rent had already crept up at renewal. Groceries cost more per trip than they did a year ago. Insurance premiums adjusted, and the baseline cost of your existing life quietly rose to meet the new income before you ever had a chance to redirect it. This is the mechanism, and once you see it, the confusion starts to make sense. Call it full board absorption. Your monthly budget is like a board with a fixed number of slots, one for rent, one for the car, one for insurance, one for groceries, one for the card payment, and so on. When every slot is already filled by a recurring obligation, a raise does not open a new slot. It just makes the existing slots slightly easier to cover, or it gets absorbed by slots that quietly got more expensive since the last time you checked. The result is that the paycheck grows, the board stays full, and the leftover at the end of the month barely changes. About half of adults reported spending less than their income in the month before a recent national survey, which means the other half finished the month with no clear positive margin at all. If there is no room left after the bills clear, a raise cannot turn into savings, a buffer, or visible progress no matter how real it looks on the pay stub. Here's where the math makes the trap undeniable. Say your raise added $300 a month to your take-home pay. That sounds meaningful, roughly $3,600 a year, but over the same period, your rent went up $75 at renewal. Groceries cost about $60 more per month than they did last year. Your car insurance increased by $35 after the policy renewed, and the minimum payment on your credit card ticked up by $20 because the balance grew slightly during a tight stretch. That is $190 a month in cost, increases that happened automatically without you approving a single new purchase. Your $300 raise just became $110 of actual new room, and if even one irregular expense shows up, a copay, a car repair, a registration renewal, that margin is gone before the month ends. But here's what makes this worse than a simple math problem. If your card balance is sitting at a high interest rate, and the average rate on general purpose cards was about 25% recently, then part of every paycheck is being pulled backward before you ever feel ahead. A $4,000 balance at that rate costs roughly $83 a month in interest alone. That is money leaving your account every single month that does not reduce the balance, does not build savings, and does not show up as a purchase you chose. It just disappears into the cost of carrying debt and it makes the board even more crowded. About 15% of general purpose cardholders are making only the minimum payment, which means the month looks manageable on the surface, while the household stays stuck underneath the balance. Now, here is the comparison that changes what this means at a bigger scale. Think about a dual income household bringing in strong headline income well above the national median. From the outside, they look comfortable. But one partner's car lease renewed at a higher payment. The other picked up a student loan that came back into repayment. Childcare costs went up again, and the insurance deductible on a recent medical bill wiped out the small buffer they had been building. They make good money, and they still do not have a real 3-month emergency cushion. Among households earning 6 figures or more, about 75% have that kind of buffer, which sounds high until you realize it means roughly 1 in 4 households at that income level still do not. The paycheck is not the problem. The structure around the paycheck is the problem. This is where a lot of viewers need to rethink their first instinct. You might be thinking, if my pay went up, I should feel ahead by now. And the fact that I do not must mean I am doing something wrong. That is not always true. Not every household at zero is there because of bad spending habits. Sometimes the math is genuinely too tight, because prices rose faster than income, because debt service eats a bigger share than it used to, or because the cost of essentials left no room for a buffer to form. And sometimes a household is not truly broke so much as scared to spend the last safe cash it has, which means they look like they have no cushion when really they are holding a tiny one so tightly that any disruption still forces them into borrowing. The trap is not always overspending. It is often the absence of margin, and margin does not appear just because the paycheck gets larger. The real dividing line is not income level. It is whether money is still left after the month lands. Among adults who reported having monthly money left over, about 85% also had 3 months of emergency savings set aside. That link is not a coincidence. It tells you that the buffer does not come from earning more. It comes from having recurring leftover. And recurring leftover only exists when the board is not completely full. So here is the 4-part framework the opening promised. First, map every recurring obligation that drafts or is due every month, not a full budget, just the committed charges, and compare that total to your take-home pay. The gap between those two numbers is your actual margin, and if it is very small or negative, that is why the raise disappeared. Second, identify which slot on the board got more expensive recently without your active approval. Things like rent increases, insurance renewals, grocery inflation, or interest charges that grew as a balance grew. Those are the slots absorbing new income before you can redirect it. Third, find one obligation you can reduce, renegotiate, or eliminate. A single board slot freed up creates recurring margin that a raise alone could not because it lowers the baseline instead of just adding to the top line. And fourth, route the first real margin you create into a separate account before the month has a chance to absorb it. Because if leftover money stays in checking, it becomes spending by default. If you are someone whose board is full and the margin is near zero, the highest leverage move is almost always reducing one large recurring cost rather than trimming many small ones. If your margin exists but gets erased by debt service, the priority is attacking the highest rate balance so the interest slot shrinks and frees up room that stays free. And if your income is strong, but the buffer still has not formed, the question is not whether you earn enough. It is whether anything is left after the board clears. Because that leftover is the only raw material a buffer can be built from. The mechanism is this. Income is a flow. Progress is what remains after the structure takes its share. A raise does not create progress automatically. It only creates progress if it survives the board. You are not failing because your paycheck looks healthy and your account does not. You are living inside a structure where every slot fills before the month ends. And the only way to break the pattern is to see the board, find the slot that costs the most room, and free it before the next paycheck arrives. In the next video, I want to show you how to build a one-page version of that board in about 10 minutes. So you can see exactly which recurring charge is doing the most damage to your margin and what happens to your cash flow the month after you change it.